From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for September 26, 2025. The team with the best record in baseball, your Milwaukee Brewers, are wrapping up the season this weekend with a 3-game set in Cincinnati. Your Green Bay Packers are in Dallas Sunday for a game with the Cowboys. And here's what else is happening this weekend. The Milwaukee Symphony is doing 3 nights of Disco Divas. Don't forget your sequins and platforms. Bayview is hosting another gallery night. That's always fun. And Open Doors Milwaukee is back for its 15th year celebrating our architecture and history with walking tours. Okay, here we go. NASA is going to save the moon. Well, NASA is going to save it from a killer asteroid. It's thought it will impact the moon in 2032, but those same scientists say there's less than a 4% chance they're right. Sounds to me like NASA just wants to blow something up. A founder of Patagonia, the outdoor clothing company, once lived on $1 a day and ate food from dented cans before he made it big. And did he ever? When he hit billionaire status, he was hungry and angry at humans and politicians for polluting and generally messing up the climate. So he's given away his $3 billion company at a rate of $100 million a year. All the money is going to combat climate change and protect the earth. Does that mean we should hold off on building that new White House ballroom? French President Emmanuel Macron and his wife Brigitte are planning to present photographic and scientific evidence in court to prove that Mrs. Macron is actually a woman. And we thought our politics was sleazy. On the podcast today, we have Adam Baley, Steve Giles, and wrapping up the week. Here's Kyle Tetting.
Well, thank you, Max. A bit of a mixed week for markets, but down overall. The Nasdaq down 0.7%, closing at 22,484. The S&P down 21 points this week. That's 0.3% to close at 66,44. And the Dow Jones Industrial Average down 0.1%, closing at 46,247. Despite the down week, still meaningfully positive on the year. Nasdaq up 17, the S&P up 13.9, and the Dow Jones Industrial Average up 9.9%, all three including dividends for the year. Adam, probably the place to start this week is just with the economic data. I think we were eagerly awaiting the inflation data that just came out today. Personal consumption expenditure wrapped into the personal spending data, right in line with expectations, and I think clear that the Fed's concerns that inflation remains above the 2% target are still warranted, even as it's far lower than it was.
Yeah, the main event this week really was the inflation data that came out. It wasn't good. It wasn't bad either. It wasn't a sign of health. Inflation, at least as core PCE, that's personal consumption expenditure. By the way, that is the Fed's preferable gauge on how we measure inflation. Even yours truly. It's my preferable gauge on how we measure inflation because it really takes into account consumer behavior. And year over year, core CPE was up 2.9%, above the Fed's comfort zone of around 2%. I guess still within the 2 to 3% framework for which they have given themselves. We did see consumer spending out there. Consumers still holding on and still spending. Part of that has come from, wage gains have still been out there, even as we have seen some softening in the labor markets. But one of the things that's materializing that I know I've spoke about this in the past, but wages relative to inflation. In years past, we had wages rising faster than inflation. But those numbers have switched roles now. Wage gains over the last year came in at 1.2%. Core CPE came in at just shy of 3%. I guess my point is 3 is a bigger number than 1.2. Inflation is rising faster than wages at this point.
And with consumption driving so much of our economic engine, clearly if we can't keep wages in line with the inflation numbers, well, it gets a little harder to keep spending more. You can do it temporarily, right? You can do it if you're a worker by putting it on a card. You can do it by just spending some of your built-up savings. But eventually that catches up. And so I think part of the concern is that we need wages to kind of continue to at least keep pace so that workers aren't ultimately seeing that erosion of purchasing power. Steve, we've spent a lot of time looking at the labor market. Clearly a lot of noise there, a lot of conversation around what has shifted. We've talked about at length how we've seen some softening. What are you seeing as you kind of look at expectations for the labor market, as you look at some of the data? We had an unemployment claims number this week, but I think the conversation is bigger than just the unemployment claims number.
Yeah, Kyle, that unemployment claim was down for the second consecutive week. You've got some labor market noise that remains as payroll growth has stalled while unemployment rate remains modest. The Fed is still cognizant of the labor market issues, but there are continued signs that it isn't their primary concern.
I think that's fair, and what's interesting in this conversation is I think we've hit the two main talking points for the Fed right at the top here, which is full employment, stable prices. Well, we're still seeing the labor market that's strong enough, even if it's weakening, and employment that's or rather inflation that's running hotter than Fed expectation or Fed target. And so if I were a member of the Federal Reserve tasked with making decisions on interest rate policy, which one would I pay more attention to? Well, I'd probably pay attention to the one that's screaming more of a problem than the other, and that's the inflation numbers. And so I think as we kind of digest what the Fed said last week, as we digest some of the comments that have come moving forward, well, I think it's clear why the Fed has erred in the way they've erred. They're simply looking at the data.
And the Fed, I think, has done a very good job navigating their meeting notes and their public comments to make sure that everybody understands the decision they're making is based solely on the data and not the optics of politics surrounding the pressures coming from somebody sitting in the White House.
And unfortunately, we've gotten a lot of noise on that this week. We've got a Supreme Court visit for Fed Governor Lisa Cook, Michigan State professor, in her off duty. And interesting how we've gotten here. But, Adam, it was also interesting to see the number of former past governors, the number of kind of former economic officials that came out to speak, it seems, on behalf of kind of the Fed.
Yeah, and by the way, it's a 33-page document filed with the Supreme Court. It's worth your time to read it. It's written in plain English, and actually it's pretty good, but it is signed and written by all living former Federal Reserve chairs, I believe all former and living heads of the U.S. Treasury, although I'm not sure on that one. But they lay out a compelling case at why the Federal Reserve Open Market Committee must remain independent from politics.
And I think it is such an interesting conversation when we kind of digest the role that politics has played in markets this year. Certainly, as we review client portfolios, Steve, there's a pretty big drop in that chart when you look back to the tariff conversation in April. We've had a nice recovery since. Some of that clearly tied to kind of expectations for the Fed moving forward. What kinds of things are you having conversations about in your client meetings, especially as we kind of look back at where we've come from?
Well, Kyle, with the markets as up as much as they are this year, year to date, NASDAQ 17, S&P almost 14. We've had over an entire year's worth of performance on the stock side in only 3/4 of the year. So from that mantra that we love to repeat, buy low, sell high, I've been doing a lot of rebalancing for clients. Everybody I talk to doesn't want to have to see their portfolio go through a severe downdraft like we did back in the spring when the uncertainty around the initial tariff announcements was causing some fear and selling panic in the overall markets. And I think it's just a good reminder that as we move forward, there are things that we just can't control. One of them is certainly the markets in general, and to make sure that you have good balance and that you focus on controlling the balance, which is what's going to drive your performance longer term.
Yeah, I was going to add, focus on the things you can control, and that's the level of risk in your account, the level of stocks that you have. And now's a wonderful time to make some practical and pragmatic changes in your account. And as we look at the markets, especially the U.S. market, there really isn't area of the market that's cheap. Virtually everything is expensive by most measures. PE ratios are expensive, just raw levels of where we are. They're at all-time highs. So now I think is a wonderful time to just use some of that information the market's giving you and make some risk reduction changes that make sense for you and your portfolio and your own goals and objectives.
I think it's so interesting. The question I've gotten recently is why, right? How did stocks get here? Because it feels, at least when you look at some of the bigger headlines, some of the bigger news stories that are out there, that a stock market at S&P 500 up 14% is a little bit more than what we should expect. And I think some of that certainly comes down to an expectation for cuts from the Federal Reserve, that lower rates means lower discounting for the future earnings of stocks, means we're willing to pay a little more for stocks today. I think you add in what has been a fairly rosy outlook for earnings growth. Some of that's been walked back a little recently, but still double-digit earnings growth looking out over the next year or two. And so I think some of that is founded on what has been a pretty rosy outlook for stocks. I think you add in some of the AI conversation. But, Adam, we got a headline today that I think points to one of the other reasons why perhaps stocks have had some support beyond just maybe what we otherwise would have thought.
Well, yeah. And, part of that is just, trade deficits. We've run sizable ones, and you kind of flood the globe with dollars. Those dollars have to go somewhere. And a lot of nations or other countries or other businesses that trade with us, that those business deals are done in dollars, and now they're holding dollars. So what do you do with them? You go back and sometimes you purchase treasuries, sometimes you just purchase U.S. businesses. And the level of foreign ownership of U.S. markets, I believe, is at an all-time high.
Steve, the money chasing U.S. stocks from foreign investors, okay, clearly part of maybe what gave us more buyers than sellers. At the end of the day, having more buyers than sellers makes something more expensive. But there is this potential now for stocks at high prices and at a point in time in which we clearly are rethinking our place in the kind of global marketplace and our place in global trade, where potentially some of those dollars have to flow back out. So what happens to investors' portfolios if we now get more sellers than buyers because those foreign investors are now going back the other direction?
Yeah, asset prices will go down. It's as simple as that. I think it's a good lesson in making sure that your portfolio is well diversified. One of the areas that we have been increasing exposure to for client assets at the firm is international investing. A lot of international has done better than the domestic markets this year, in large part to the currency exchange that we're talking about. And don't misrepresent what we're talking about right now. The U.S. dollar is not weak. The U.S. dollar has weakened for the year to date. There's a big difference, but that weakening dollar has created a tailwind on foreign investing. So through the currency exchange, foreign profits repatriated back into U.S. dollars, you do get that added leverage that adds a bit of a tailwind to your performance. And let's face it also, international investing is just a bit more attractive from a relative valuation basis right now. So, one of my fears is that all these foreign dollars that are investing in the U.S. Recognize that they might be able to get a more attractive price in their own countries. And there's a huge exodus of U.S. dollars from U.S. investments into, for us, what are foreign investments. That could have a dramatic effect on our markets here locally.
I'll add to that. I mentioned before that U.S. stocks are historically expensive, just price to earnings multiple, but that's not the case everywhere else on the planet. There's a lot of well-run, very profitable businesses trading overseas at reasonable prices. And on top of that, you have a lot of European businesses that historically have paid double the dividend rates than what we have been accustomed to here in the United States. So, it's a wonderful time to be a non-U.S. investor. For what it's worth, if you're looking at your non-U.S. investment funds so far year to date, a lot of them are up 15, 20, 25%. Some of that has just come from currency fluctuation. Some of it has just come from those businesses have done well.
Yeah, but nothing's for nothing, Adam. Understand that for our listeners, international investing is still a more volatile investment than what you're going to get domestically. So everything in moderation. Just be aware that from an asset allocation standpoint, international is one piece of your total portfolio.
Well said.
I think such an important conversation. I think given how much of that conversation has been driven by changing global trade, it's been interesting to see this week how much we have kind of seen headlines on how, while global trade hasn't slowed, it's just shifted. And China is still dealing with record trade surpluses. It just so happens that who they're trading with has certainly shifted away from the U.S. and towards maybe the EU, other parts of the world. And so as I kind of think through for investors, what does that mean for, Adam, a lot of those businesses you highlighted, even sometimes businesses in countries where maybe we're not terribly excited about the economic outlook? Well, perhaps a reminder that a lot of those businesses sell to parts of the world in which there might be some more growth opportunity.
Yeah, and we kind of see that materialize with China this year, where a lot of the products that were maybe destined to our shores have been switched to other places in the world. And it means that the Shanghai ports shipped a record number of containers last month. Sales of Chinese goods have surged elsewhere in the world. FYI.
Yeah, worth noting that I think it's not always about just what happens here. We do have to keep the bigger eye on what's going on globally because it is a global investment opportunity. With that, we enjoy doing the show for you. We'll talk to you next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.